Hi, my name's James Nunn, and I'm a commercial fund manager at Octopus. I'm going to talk about enhancing success in this market and ways to increase broker fruition. Finding the right borrower is tough for brokers, particularly in this market, as is trusting the lender to proceed through to completion. Brokers are particularly important to Octopus, especially as the majority of instructions come through them. As a result, we speak with them regularly to understand how to improve what we're doing. Keeping our process clear, friction-free, and efficient as possible is important to retaining trust in us. So why trust Octopus? It'd be useful to explain our analysis process and what we've been completed and what we completed on recently. Hopefully, this will lead to a higher amount of completions and provide more confidence in us as a lender. Firstly, I think I should provide some more information on Octopus Group, which will hopefully begin to build that confidence. Octopus Group was founded in 2000 by 3 entrepreneurs, 2 of whom are still active in the business, namely Simon Rogerson and Chris Hewlett. The company is a UK investment manager with offices in London and over 9.1 billion of funds under management. We invested in strategies across real estate, renewable energy, venture capital, and small to mid-cap companies. Octopus manages money on behalf of retail investors. So basically, we've got our work cut out. So, on to the most important part, real estate. The real estate team has 2.3 billion under management and is split in 2 main departments, lending and healthcare. Healthcare has a real estate investment platform and manages over 60 purpose-built care homes. They also focus on retirement and provide equity investments to retirement community developments, and also form joint ventures and with developers and operators. The lending side provides bespoke loans within commercial, residential and development. Today though, I'm going to talk to you about commercial lending. So let's start off with the current market sentiment and appetite in commercial lending space. So Brexit has finally been agreed, mostly anyway, and we begin to see that in the rearview mirror. There are some issues to be agreed and financial burdens to follow. However, there are reasons to remain optimistic. For instance, agents are still predicting in the short term, overseas investors will increase investment volumes. Finance jobs have retained in the UK despite 3.5 years of Brexit mayhem. And sterling is on the up, with hopes of a recovery to the economy. We also have major markets in propping up the UK. We are the 2nd largest market in the world for fund management, only behind the US. The UK insurance sector is the biggest in Europe and 4th largest in the world. And the legal sector is the largest in Europe and the 2nd largest globally. So, all relatively positive. But time will be the best test of Brexit and its impact on the UK economy. Moving on to COVID and the main cause of our lending appetite changing. In the normal market, Octopus has lent against offices, shops, shopping centres, retail, retailizing, industrial, logistics, hotels, etc. However, since the outbreak, we've been closely assessing each of these. So let me take you through them individually. We lend on land with planning across all asset classes. However, a large proportion of our loans are against land with planning for residential sales and PRS. The residential market remains open, unlike the first lockdown, so there will not be the same degree of disruption, which actually resulted in a very strong year for the sector. House prices rose 6% year on year to an all-time high, while mortgage approvals ended a 13-year high. The market is expected to slow, however, as stamp duty holiday comes to an end in March. There's also been a marked dip in the rental market across the city. The average rent fell 6.9% leading up to October 20. Central areas have been hit hardest. A 1-bedroom flat near Piccadilly Circus, for example, has recently cut its asking price by 43%, and we expect this to be similar across the UK. However, we remain optimistic over this sector, and we continue to lend on land with planning consent up to a maximum LTV of 65%. Where we excel is lending against purchase options. The value uplift is considered, and we lend against the market value and not the purchase price. In some cases, this exceeds 100% loan to purchase, making this a very competitive offering. We will also look at outline planning consent subject to reserve matters and pre-commencement conditions. We move on to logistics and industrial, which continue to thrive as consumers shop online and technology grows. Over the medium term, an increase in supply will steady, and in some locations, rental levels will contract. However, we see demand for space still being high. We're currently lending at 65% LTV throughout the UK on vacant, occupied, single units and estates. Hotels. The revenues are being hammered, which will place further pressure on the sector, unfortunately. Rent and interest payments continue to be suspended for much of the industry too. We are still lending on hotels, however, in a cautious way. We've retracted away from cities and national covenants with a shift towards boutique and holiday destinations. They have been more flexible and weathered the storm so far, with people holidaying more in the UK rather than abroad. Our LTV appetite for this sector is around 55 to 60% at present. With retail, fundamentally landlords are taking a big hit in this sector. Hammerston managed to collect just 1% of quarterly payments, as the UK shopping centres had no one in them. It's estimated that every week that shops are closed, the retail sector loses £2 billion. In addition, 250,000 people are on furlough in the retail sector, and it's estimated that 200,000 people will lose their jobs in 2021. With this in mind, we remain cautious on the high street retail, with a focus on locations dominated by independent retailers and low vacancy rates. We will lend up to 60% LTV, and the more bullish on retail warehousing at 65%. Retail warehousing is still liquid, which can be evidenced through the £300 million portfolio acquisition made recently by M7. Shopping centres, however, remain at the bottom of the pile, and an asset class we're not willing to lend on at this point in time. The extent of the damage of the office sector from lockdown clear. IWG, the world's largest flexible office company, took a £160 million hit to cover the cost of ditching millions of square foot of office space. However, some people such as Bruce Flatt of Brookfield believe that workers will return and the office market will quickly recover. Further to this, Workspace has reported this week in the press that they're seeing resilient demand for space and have collected 91% of their rent. Our view is offices remain closed. This will further entrench a permanent shift towards increased working from home. Vacancy rates have also risen to a 10-year high in London and across the UK. However, the majority of agents still are reporting strong demand for prime space. As such, we still support offices in and out of town and lend up to 60% LTV. So car showrooms have been closed during this lockdown. It's been reported in the press this week that UK car makers are to face more job losses after the sector's worst ever year since 1984. That said, the industry forecast 2 million new sales in 21, up from 1.6 in 2020, but below the 2.3 million mark in 19. We look fairly positively on the car showroom sector from the short term anyway, and we're lending up to 65% LTV on well-let and well-located assets. With student housing, schools and universities are restricted to online learning, which will put pressure on operating margins for the current academic year. We still have an appetite to fund student accommodation, but require best in class to reach our upper lending cap of 60% LTV. Pubs and leisure, unfortunately, remain outside our lending appetite at present. However, we're continually assessing the market on when best to re-enter it. So how do we lending? Our commercial lending is from our discretionary fund, which means that Octopus is the ultimate decision maker. There is no external sign-off and no reliance for external funding. The commercial team is made up of chartered surveyors, so we should be able to get our heads around borrower requirements and understand assets pretty quickly. This in turn speeds up the underwriting process for the borrower. In fact, all decisions in the team have spent viewers, so know exactly what they're looking for as an asset. We also have all been equity investors, so have a good understanding of what sort of business plans are deliverable. As mentioned, the whole underwriting process is undertaken internally. This involves a number of teams working with commercial and includes sales, customer, servicing, credit, and development. As none of these elements are outsourced, it keeps our service smooth, efficient, and personable. So exactly what is the process then? So we front-end a large proportion of our analysis in an initial report prior to issuing credit-backed terms. We believe this offers a degree of certainty early to the borrower, reducing the likelihood of the deal falling over later on. It is the main reason, it's the main decision-making process and takes 24 to 48 hours to complete, subject to the necessary information being provided by the borrower or the broker. It's a detailed 8 to 10-page document and includes the main points include information on the security and location, an opinion on the proposed value and the analysis around that, purpose of the loan, borrower information, and details of the exit and how it will be redeemed. If approved, credit-backed terms are then issued. If these are agreed by the borrower, the deal then moves through to appointment of legals and the valuation process. After the valuation is written, submitted, we will write a final paper and move through to completion. After this time, broker fees will be paid immediately. Importantly, what's the timing of achieving all of this? If a valuation is required, then from inception to completion, it generally takes around 4 weeks. It depends on the quality of the information provided. We have undertaken loans as quickly as 3 days. However, the valuation was completed and the information was available. So, what can be done to streamline this process? Well, providing us with detailed information on the property, detailed information on the borrower and structure, and comprehensive financial information, as well as clear, comprehensive exit, and loan will be redeemed. All of this helps keeping the time and completion down to an absolute minimum. So, moving on to some real-life examples. We've continued to lend on a significant sum of money through the pandemic. So I thought I'd finish by showing you 2 recent case study examples of what we lent on last month. The first land loan in southwest London with residential consent of up to 35 units. We lent at an LTV exposure of 60% and completed the loan within 3 weeks. The loan was slightly unusual, as we also funded the VAT payment, which we're beginning to do more regularly. This will be redeemed via an HMRC rebate before the main facility. The main requirements for a VAT loan are that we have a first charge over the asset under the main facility. We confirm that the borrower's accountant for the property is eligible for a VAT rebate, and the borrower's company is not part of a wider VAT group. Go on to the second loan. This was a vacant industrial unit which was going to be refurbished and relet over our loan term. We lent at 60% LTV and completed the loan in 4 weeks. The borrower had a good track record with letting and selling industrial units, so Octopus was happy to support him through the process. The refurbishment works are being monitored by Octopus and further advances being paid. However, if the works are substantial, which they weren't in this case, we instruct a QS to monitor them at the cost of the borrower. So just to wrap up, Hopefully that provides you with an insight into what we're currently looking at and how we work with brokers from inception to completion. Monthly interest rates of between 0.75 and 0.95. I think we feel we're pretty well placed in our space in the lending market. As mentioned, due to the experience of the commercial team, we do regularly lend against assets that are classed as more unusual or complicated. So please do pick up the phone and discuss anything with us. Finally, many thanks for listening. Good luck and good luck through 21.